Okay, moving swiftly on. We've got a panel. No, that's too much for him. No more panels. Right, we got a panel. Again, it's not by me, right? It's being moderated by Tessa Walsh from the London Stock Exchange Group. Please, if you would like to introduce your panelists, and this is going to be on another topical subject, okay? Whether we like it or not, it's a topical subject. Climate change risk and the bank operating model. Transitioning to business opportunities incorporating ESG, environmental, social, and governance. I always think we should split the governance away from ES, because governance has been perennial, right? ESG and Sustainable Banking. Tessa, it's lovely to meet you, although we did meet on the flight yesterday. If you want to introduce your panel, go right ahead. But yeah, by all means. Floor is yours, Tessa.
I'd like to say
you need to go right up to the mic.
Okay. I'd like to say, just to start off with.
Yeah. Can you hear her? Two. Try that.
I'll have to shout louder.
Yeah.
I'd just like to start by saying that I'm delighted to be here with you today, and thank you very much for inviting me. I'm Tessa Walsh, and I am the ESG financing editor for the International Financing Review. We're part of the London Stock Exchange Group, LSEG. And I'd like to introduce you to my distinguished guests on my panel. The title of the panel is Climate Change, Risk in the Bank Operating Model, Transitioning to Business Opportunities Incorporating ESG and Sustainable Banking. And I'm delighted to introduce my panelists here in person and remotely. We have Saloni Ramakrishna, author, columnist, and banker. Author of Climate Change Risk Management and a senior director at Oracle. And we also have Maram Al-Jazeera, global head of financial institutions at Arab Bank and chief sustainable officer. And joining us from London, we have Anna-Marie Slot from Transition Value Partners, who is going to give us her expertise as well. Please sit. I might join you actually, because I think it would be a better discussion if we're all sitting down. But I've given the audience a little insight into what we all do. But I'm thinking that with the wealth of senior experience we have here, it would be good to hear a little bit more about your individual roles before we kick off the discussion. So, Maram, can you just run us through your role at Arab Bank, and then I'll ask you to do the same, Saloni and Anna-Marie also.
Yes, hi Tessa, and I'm very happy to be here. Basically, I'm currently double hatting. So my original role, which I've been in for so many years, is Global Head of Financial Institutions at Arab Bank. And currently, a few years ago, I was volunteered by our CEO to be the ESG champion, and that transitioned into an acting Chief Sustainability Officer role where I am mandated to actually execute the ESG strategy for Arab Bank and embed it in all layers of Arab Bank, whether it's at head office or throughout the network.
Hello. Yeah. First, namaskar, and I'm so delighted to be here. I have traveled extensively, but this is the first trip where even an hour before me leaving, I wasn't sure whether I was leaving. So it is one of the most interesting experiences to be here, and then to come in here and the total calmness of this place and the comfort with which we are all here actually makes that very unreal, you know. So delighted to be here, and I am here more as an author of my book, and Murad, Professor Murad was the person who motivated me to be here. Thank you so much. Who am I? Well, that's a very difficult question. I think we all go that journey. But I am from Oracle, but before that, I've been a banker. And I continue to be a banker at heart and mind. And so much so that in my company, they call me the banker. That's a monochrome that they have for me. And Climate change and ESG is something that I am both personally and professionally very passionate about. Simply because of two reasons. One, as an individual, as a global citizen, but two, equally important as a banker. Because I think what it means to the industry, which is the financial lubricant of the industry, what does it mean to us as bankers is something that motivates me. You know, how can we be profitable, because at the end of the day, we are commercial organizations, and still be in the path of journey towards low carbon. So I am focused globally. I have a global role on ESG, solutions, analytics, and so on and so forth. So I continue to be in this space, and I'm so delighted to be here. Anna.
Hi, hopefully you can hear me all right. I'm Anna Marie Slott. As Tessa mentioned, I'm the co-founder of Transition Value Partners. I've spent the last 2.5 decades in the world of leveraged finance as the global head of high yield for Ashurst, which is an international law firm, and really spending all of that time working with banks, representing banks and working with companies around risks and opportunities. And so it's with that nexus of leveraged finance and in particular sub-investment grade debt in emerging markets background that I come to climate and the transition of decarbonization. So very pleased to be on this panel. My deepest apologies for not being able to make it in person.
So, Maram, can you tell us how you're embedding sustainability in our bank and all the work that, can you just outline the work that you're doing and the processes that you've been through to make that happen? Thanks.
Well, I'm gonna have to take you back in history for our bank. Ever since its inception, we've been going through the motion. The core of our bank in terms of lending, in terms of going about its operations, is all about responsible banking. So we've been going through the motion without actually using the terminology of ESG in what we're doing. And as we've gone through, and our CEO, Renda, mentioned that it's a journey. So as we were going through that journey, it sort of came naturally for us to transition. And we decided in early 2000, around 2010, that we were going to measure our internal operations in terms of sustainability, and we're going to record it and report it. So we were actually among the first in the region to issue our sustainability report, which dates back to 2010, and we haven't stopped ever since. So it's been an annual issuance every year, and every year we continued to perfect, we continued to learn, so it was a learning curve for us. So again, naturally, that journey transitioned into a discussion at the leadership level where we were talking about our growth strategy. And it came naturally to us to say sustainable growth strategy. And what comes with sustainable growth strategy is, okay, we're gonna go for debt issuance to support the growth strategy. That's gonna be a sustainable debt issuance. What comes with that? And again, I'm just going through that thought process because you asked. And we said, okay, we have to establish a sustainable finance framework because it's all about governance at the end of the day, and the framework gives us that governance tool. So as we went through that motion, we realized that it's not enough to just have a sustainable finance framework. We actually have to live it. We have to live that spirit as well in terms of actual action points. So we finalized the framework. We posted it on our website. We decided that we were going to go ahead with our AT1, our sustainable AT1 issuance, securities issuance. And we said, okay, we want to embed this as a part of an overall ESG strategy. So we ended up hiring the expertise, and we ended up sourcing our internal expertise from our sustainability reporting. And that's when I was also volunteered as ESG champion, because we realized that you can't go about expertise without a culture. You had to adopt the culture. And without divulging my age, I've been with our bank for so many years, so I sort of know the culture inside out. And you need someone that can help navigate that culture across all layers of the bank in terms of sustainability. So that's when I started working with the team in order to set up the ESG strategy. The tone is at the very top, at the board level, which is the start of our governance structure. So we've completed our governance structure. They set the tone. We have our executive leadership that actually sets the strategic direction. We've established an ESG office that implements, that comes up with the details of the strategy and implements it alongside our sustainable finance working group, which is based on a number of functions within the bank. And we also, because there's also innovation to it, so we also decided that if we're going to embed sustainability in all layers of the bank, we have to engage and collaborate with our employees as well. So we also have a layer of ESG champions across all functions within head office and across our network, in a nutshell.
It's quite a journey. Thanks for mapping that out for us so clearly. So, Saloni, given your experience in the banking sector, how are the people and the clients that you talk to dealing with their journey ahead? What are the common strands and threads that you're able to pick out? And how is technology helping?
Yeah, so first I think, like all new upcoming subjects, this is a subject full of jargons, right? So I'll try to go to the fundamental part. ESG is environmental, social, and governance, which is basically the idea is how do we handle these three in a way that there are multiple objectives that are met simultaneously. But as bankers, I think one of the bigger ones is the E part of it, so much so that EBA and ECB, sorry for the jargon, European Banking Association and European Central Bank and Bank of England, which lead this charge, have focused on C&E risks for the banks, right? So climate risk is a risk because you do not dictate climate. You do not know what climate is going to bring to you, right? And I come from an analytics background, and therefore I'll tell you how your question of how banks are dealing with it. The banks are dealing with it based on two aspects. Aspect one is the whole regulatory focus, right? So if you look at the whole geography, you will find that the European Union, all the banks in Europe, and UK are the front runners. That's because the regulators govern and lead that whole march. And closely following is the second spectrum, which is the APAC, which is APRA, Australian Prudential Regulatory Authority, the Monetary Authority of Singapore, Hong Kong Monetary Authority, and of course the country I come from, Reserve Bank of India. So these all are more or less in the same line, but with a little line, right? Then you come to countries, Middle East, let's say, and I think COP28 actually marked a big showcase of how this region is looking at it. So from a regulatory perspective, it's no surprise that banks in the country which are highly regulated on this space are moving faster because that's what they need to do. The second angle that I was mentioning, and I think this is the angle I want all banks to follow, is what is in it for me? Meaning, what does it mean to follow this? Where are the opportunities? Where can we make that huge win-win situation where you go to low carbon situation and at the same time create, and I draw from the CEO's statement earlier, customer centricity. How do you ensure that your customers transition in a way that is in alignment with the overall structure? So that, I think those are the two trends that I see. And the conversations with different banks in different countries actually showcases it. And the evolution, and I think we spoke about banking crisis at least twice during this conversation. And I remember in one of the conferences I was saying, BC AD, the calendar divide. But for us, for bankers, BC is before crisis and AD is after destruction, right? The 2008. The fact really is that event, and then the COVID, and now this, the difference is those two were revolutionary and this is evolutionary. This is coming on us like that at a pace that we want to, but banks are hugely resilient. And this is my experience across time, whether it was the 2008, whether it was COVID, or whether it is now, they are able to relate to it, and I'm very sure they will be resilient to this as well. I think the challenge really is to find that win-win combination between regulations, between banking direction and with customer interest.
Thank you so much. Anna-Marie, can you tell us about the work that you're doing? I know that you're very involved with C-suite discussions at the moment, and also could you just give us a little bit of benefit of your experience in the regulatory world as well, and just run us through some recent developments there? I'm sure there'll be quite a crossover of the two, but we'd love to hear more.
Sure, happy to. So yes, as you say, at Transition Value Partners, we work with C-suites and with boards in particular around transition policy and strategy. And what that means really for boards is, this is not necessarily something that boards are very familiar with at the moment, and everyone is upskilling themselves. That's very difficult in some ways for a board to do, to admit that they don't have all the information that they need, given that they're such a kind of learned group in the room. But it's really something that the boards that are taking advantage of all of the regulations and the reporting requirements that are coming at companies and at institutions, financial institutions, to create an opportunity, a space to look forward and say, okay, this is the evolving landscape. Saloni used a lot of great words there. This is the evolving landscape. What is it that we need to be doing both to create our own resilient future and sustainable future, but also to capitalize on the opportunities from, the kind of massive industrial revolution that's essentially going to be coming as a result of decarbonization. This decarbonization of the grid, decarbonization of major industry. Those are enormous areas for innovation and growth that people need to take a little extra time to fit into kind of their BAU discussions on what's happening at a kind of corporate level, but also what's happening in the wider scope. I mean, when, at Transition Value Partners, we use an expression called geosystem strategy, which is, the ability to bring together your innovation function, your strategy, your sustainability, and what you understand is the policy frameworks that you operate within, combining those together to really build your future-centric company and, in many ways respond to what customers and clients need to have from corporations and financial institutions as we know it. So, as others have mentioned, there's an alphabet soup in the world of sustainability. I don't know if it came from the fact that they started with 3 letters of ESG, but conveniently all of the regulations have followed in their footsteps and are all abbreviated down into multiple acronyms of multiple confusing letters. So, but I think conceptually, if you think about the reporting that's being asked for and the transition plans that are starting to evolve, Saloni is completely right. The EU and the UK are probably the most active in the regulatory space here, followed closely by APAC. And most, if not all of those, build on this concept of what's called the TCFD, the Task Force for Climate-Related Disclosure, which was put together. It was an industry-led initiative put together by Mark Carney and Bloomberg and a number of others to create a framework through which you can assess the risks and opportunities from the evolving climate change and the impacts that it's having on business. And so that TCFD framework kind of iterates through a number of regulations that you'll probably have heard in passing, like CSRD, which is the Corporate Sustainability Reporting Directive, which is the EU's kind of signature latest regulation on this. This is part of the EU Green Deal framework to, again, transform the EU economy into something that is resilient for the long term. These are all based on different ways of asking financial institutions and corporates to start thinking about what are the risks and opportunities that are presented by climate change. And the most probably interesting and distinctive aspect of the regulations are they are forward-looking. So they ask people not just to think about today, but what does that look like in 3 and 5 and 10 and in 15, and assess the risk in that way, which I think is somewhat a novel approach for people whose normal kind of business planning scopes 3 or 5 years, to think, what does that look like in 15 years? And, am I able to, finance that or insure that asset in that time period? It kind of is trying to create a space for that discussion at the C-suite.
Thanks so much for running us through that. I would probably add something. We're now starting to look at transition plans quite carefully. I'm just going to come on to that in a minute, but I would say I really appreciate how timely this discussion is, because we have had COP28 in Dubai, and we're now moving forwards very quickly into COP29, which is coming up in Azerbaijan. So many of these topics and themes are going to be very front and center in the next couple of months. I've just been to Climate Week in New York, which was an amazing experience. I can share any insights from that with you later if you would like. I would say also a personal plea, don't be put off by the acronyms, because they sound a little bit dry, but what we're actually talking about is massive systemic change that's going to affect all of us. So with that, I'd like to turn to transition now. Maram, you wear 2 hats. You're head of global financial institutions, and you're doing sustainability for our bank. So can you give us some insight into where you think banks are making some progress and where you think the challenges are across the sector, broadly speaking? And I think I'm going to ask all 3 of you that same question because it's so interesting.
I think, okay, this is supposed to work, but it's not. Okay. Thank you. Okay, let me just switch this off. I think, wow, this is loud. Okay, so basically, one of the challenges that I faced, and I think the fact that I have dual roles, and because of my role as head of FI, where I have constant access to our global banking relationships in the EU, where they're very advanced in terms of the taxonomy, and all over the world. So there's always a lot of benchmarking. And the one thing that I did realize is that there was a lack of standardization. So different regions, different banks, they're going about it differently. And I remember when we had that discussion, I kept saying that you can't look at one bank and say, okay, this is how you do it. You have to look at so many, and then you have to look at yourself as a bank, as a culture, and say, okay, what works for us? And even by the same token, even the regulations across different parts of the world are quite different. And I think it also depends on economic challenges, it depends on economic visions. It has to be relatable in order for institutions to be able to implement. There has to be a lot of collaboration within the markets in order to make sense of what needs to be done. But I would like to take advantage of that question, if I may, Tessa, because while I was doing the research and just seeing where we're at as a region, and of course we are a part of a closed system here, but I'm just going to focus on the Middle East here. We as a globe have committed to capping the increase in temperatures by 1.5% by 2030. Now, given the projection on the Middle East, we're actually projected to increase, to actually achieve or let's say reach a temperature increase of about 4 degrees centigrade in 2 decades. That is very scary. So that is an alarming statistic that we have to pay attention to, not just as a region, but also as the rest of the globe. Number 2, poverty and inequality. We started out at 12.3% in 2010. It has increased in the region to 18% in 2023. That's alarming. We also have female labor participation rates at an all-time low of 19%. So when you're talking about transition, we have a lot of work to do. And that pretty much sets the course of where the markets in the region are heading in terms of economic strategies and visions as well. So in As our bank and as a regional bank, we're very sensitive to what the governments end up projecting in terms of their visions, because we are also going with the flow, and we're a part and parcel of that sector. And we're just hoping that we are going in the right direction and there aren't any challenges, and we are facing challenges right now. But that would be the transition for us.
I hope, yeah. So you were talking about the transitions and how we see that. So the two hats I wear is the technology, the earlier part of the question, which I kind of held on to respond later. And the second is the banker in me. I mean, I just can't kind of think otherwise. So if you look, one is the expectation, the second is the actual, and she's given a lot of numbers and data points for us to look at. Now, the first part, as I see, is acknowledging there is a problem, right? So EBA, in its most recent stress test, said that 80% of the banks acknowledge that they have a climate risk. And most of it comes from two aspects. Physical risk is unknown, right? You never know when a tsunami is going to hit you, when a flooding is going to happen. And in a very minuscule way, banks have handled that before. There were natural disasters before. The problem really is on transition. How does the transition work? In one of my blogs, I was writing, everything that glitters is not green, right? So if somebody comes and says, I have a green option, give me a better lending rate or whatever, the problem really is, does the bank have the ability to assess whether that technology is going to work, whether the transition map that has been given could be realistic? So I think the whole process of transition financing, going with your client for transition is going to take time. I love this quote that I heard from an American banker who said, all brown will not turn to green overnight. It will not happen. But slowly, brown will become green in shades. And that is the transition part, right? So the technologies have to evolve to support the kind of renewable world we are looking at, low carbon world we are looking at. I think this morning, somebody was, I think Stephen was mentioning that last of the coal productions has happened. And it's always a matter of time, right? There was a time when coal production was considered really value. So this whole journey, A, it's evolving, B, it is costly, and C, without any question, it's the future. So I think we will make progress, we will stumble along the way, but we will kind of stabilize. So the omnipresent idea here is technology. Both with the banks and with the renewable or the other transitionary technologies that need to come in. And above all, there was a social aspect that Maram mentioned. You know, in ESG, the focus, while for banks is largely E, because that's where they can make a major difference, the S is equally important. But the transition in E, I think, will happen sooner than in S, if you will, because this is where there is a data-based information where you can actually see the movements. So I do see that transition will happen. There's a great gentleman called Swami Vivekananda who said, you know, misery comes from choice. Here there is no choice. You have to move towards the low carbon situation. That's what the regulation would do. And more importantly, yesterday I was talking to one of our esteemed colleagues who said that, with whom I was mentioning, I don't know about this generation, but the next generation is very focused on a very sustainable future. So investor confidence, customer confidence, all of this is going to force transition. Will it be big leap? I don't see it. I'll see it as evolutionary, but that will happen.
Thank you. Yeah.
Yes.
To your point, Saloni, now, I absolutely agree. It's probably easier to handle the E part. However, it's very important to note that E and S are connected. So if you focus, and as banks, if we focus on lending, on renewable energy, solar energy, wind farms, even down the line, green hydrogen, you actually create jobs. That's an immediate connectivity to the S part. That's where you actually contribute to employment. And as you are going ahead with such financing during the transition, we all realize that when you actually diversify away from, let's say, fossil fuels, and this is a part of the economic vision of a number of the GCC countries, that you actually contribute to the GDP of these countries. And when the GDP of the countries improves, you have a lot of the S factors improving as well. So it is very much interconnected. You do have to start somewhere. But as Saloni said, it does take time, and we need to appreciate that it does take time.
I'll just add one rejoinder to that, can't resist. There is this book on 7 effective principles of successful people. One of the principles that I kind of very closely align with myself is your circle of influence and your circle of concern, right? There are some aspects of concern, and in the social area, the amount that banks can do is finite, because there is a larger ecosystem that needs to come together. And the minute they realize there is a win-win for everybody, I think that's when it happens. But the circle of influence that banks have is in the aspect of financing. They are the financial lubricants of the industry. And so to that extent, they have a better control on that aspect. But I absolutely agree that all of them are connected, and the more the social enhancement, the more the other cycles would happen.
Thanks. I want to come to Anna Marina. Transition for banks essentially requires a strong focus on clients and the kind of transactions that banks are doing and who they want to continue to do business with and who they might not want to continue doing business with. Many banks are developing transition frameworks, but Anna-Marie, can you just give us a sort of run through of what you're seeing in the sector on that front and what you think it might mean? And then I'd like to wrap up with coming back to the subject of the panel actually and focus on opportunities, because this is a very exciting time for everybody. It's once you get past the big picture, there's a realization that things are going to be very different, and that can be very healthy and quite exciting. So Anna-Marie, what are your thoughts?
Yeah, thanks. No, I think echoing what some of the other speakers are saying, I mean, transition, it's a path, it's a pathway, right? It's movement, and I think that's what people need to embed in their thinking. They have to think, okay, so how many of the assumptions coming into my assessment of this asset, this business plan, this transaction are based on a false sense that the physical world will remain as it currently is today. Because that's what we're talking about. We're talking about asset level understandings that then drive bigger strategies. And that's why FIs are at the middle of this, because they intersect with every part of the economy when it comes to financing the world, right? And they themselves have obligations to act in prudential and responsible ways. And in order to do that, I think that is where the opportunity for understanding transitions and transition pathways for major parts of the economy is critical to really both helping protect the FIs from risk, helping to protect customers from risk, but also opening up the avenues of where the economy is going, where the demand is going, and creating those opportunities, Tessa, that you were talking about. I think, you know, a couple of the key points that are talked about is this, you know, this role that the FIs play within the wider economic system. You know, in order to play that role, you also have to, as you know, as your own entity, be aware of what exposures you have. And this isn't, in some ways, it's not new. You know, companies are always being assessed on risk. That's why some companies are AAA, and that's why some companies are sub-investment grade, right? And so it's that integrating this understanding of climate transition, mitigation, and adaptation that needs to come into that existing risk analysis. And in some ways, it's completely new. People are not very aware of what those risk pathways look like. There's lots of opportunities to upskill yourself and upskill your teams through pathways that are being put out by the IEAA, or the International Energy Agency, through the Intergovernmental Panel on Climate Change. These are people who are putting out science-based information that you can take into your business strategy and planning. I think that's not, that itself is probably new. The idea that you're operating in a transitioning world is not new. The internet was a transitioning world. AI is a transitioning world. The evolution of digital banking is a transitioning world. These are all things that sort of uncertainty of where things might go is not new. The trajectory of the fact it will change is something that people need to take on board and really then get themselves around the science of climate change to understand that risk. And also, Tessa, to your point, to understand that opportunity. I mean, investment in renewables has outpaced investment in oil and gas, I think, since about 2018, right? That's a growing market. That's a growing market for employment. It's a growing market for SMEs. It's a growing market for innovation. It's a growing market for startups. Climate tech is a huge growing market that's exploding. If you look at the influence of things like the Inflation Reduction Act in the United States, which is essentially a big pot of money that says if you do things that are aligned with a sustainable and resilient world, we'll give you some cash to support it, which is a different regulatory approach than the one taken in the EU and the UK. Those are opportunities for business to really grow and flourish, and frankly to future-proof where they're going and what they're spending their money on. And FIs, banking those institutions and banking those companies should be, aligning these frameworks with that future. And that is what we're seeing. I mean, we see them. Yes, there's big numbers that you announce. It's not really about the big number that you're announcing. It's more about the trajectory of being able to assess where clients are going, which clients need the support and the help, which clients are actually probably going to be the winners in this race, because the race is on.
Thanks so much. I think I'm going to maybe ask a last question, although I'm sure all of us could talk for ages. But in terms of sort of focusing maybe on those opportunities and perhaps the flip side of that as well. Maram, what do you see as the areas that you want to or need to focus on? And what are the near-term developments around your role in your bank that you see as pressing?
To me, I believe the most important thing is reading from the same book, the same page. So knowledge sharing is extremely important. As banks, we're the vein of the economies. So that just means that our influence and our contribution is definitely felt across different sectors of the market. This is an opportunity where you actually go ahead with internal education and educating your teams, educating yourself, educating the employees, and also working and collaborating with our customers and educate them, and also educate as in knowledge sharing, and it goes both ways, and to see how we can actually enhance the products and services that would serve these customers in order to contribute to the economy and the community that we're a part of. We've been seeing in the past few years a lot of collaboration with the Central Bank of Jordan, for example. There have been a lot of workshops, a lot of sessions on ESG, and it was a very collaborative discussion because we all needed to understand what we needed to do. So that comes with opportunities. Speaking to Anna Marie's comments on renewable energy, for example, again, going back to the Middle East, in terms of solar energy, 25% and I'm sorry I'm going with statistics, but really ESG is a science and it's all about data and the facts. 25% of the solar energy is actually in the Middle East. It gets directed at the Middle East. That is an immediate opportunity right there for companies and governments and banks in the region to actually invest in renewable projects. It just makes sense. We have the capacity as a region to provide 50% of global consumption of electricity. That says a lot. So right there is an opportunity. And there are a number of countries that have gone in that direction. Jordan is among the top countries in terms of investing in renewable energy. And again, it helps with the GDP. Wind farms, we have incredible capacity in terms of land availability in order to build wind farms. And down the line, green hydrogen is a part of the strategy of a number of countries in the GCC, and they've already started discussing the potential and the possibility. There is room for innovation. There is room for technology. Climate tech is of growing importance. And I believe that it's a variable, there are a lot of variables involved, but it has to be collaborative in order to have the most impact and benefit.
Thanks. Saloni, what are your thoughts about opportunities?
So since this is the last question of the panel, I want to say each one of us sitting here is impacted by what's happening, either as policymakers or as policy implementers or as policy receivers, as customers, right? So all of us are in some way. We're talking about the operating model, impact on operating model. Believe me, this was a very nice sentence I've read somewhere. We said, we all have a new pack of cards served to us now. It's very different. It is something we're not earlier used to. And as a banker myself, I think we've all learned to model risk, but have we learned to model uncertainties? No. And climate is an uncertain aspect. We're trying to do scenarios of it. So I'll share with you some of the examples that my banker friend shared with me, which will be of help to everyone here. The first is a UK bank, what it means for opportunities. Firstly, we are looking at sustenance, we are looking at growing at the same time. And this was a beautiful example. I can't take the name of the bank because it's in confidence that he has shared with me. He heads the ESG operations. And you know what they did? They created a front end for their customers. So the customer comes there, and what they promise is you want to do your health check of what kind of the ESG score you could get, and that comes up there. Once that comes up, and this is the brilliance of that bank, what they've done is they said, if this is your concern, these are the products. Can you think of a better way of marketing your new products? So immediately it tags these 3-4 products. With these, your net zero percentage will come down, your emission will come down, and immediately the customer wants to know what is it about. So marketing has taken a new way of how you look at this whole aspect. The second is another brilliant example from an Indian banker friend who said, you know what we now do? We offer discount for every carbon positive product, okay? But they're smart. They said, we give this discount of 50 basis points. If I was talking in Japan, people will just fall off the chair because 50 basis points is the kind of upper limit. But in country like ours, 50 basis points is fine. But they don't give it up front. And this is where banks need to learn the risk management side. They say, we set KPIs, and as the customer achieves those KPIs, the discount will be passed on. What brilliance. And this is the innovation we were talking about earlier. The whole idea of how you innovate and adapt and move your operating model in a way that it is a win-win for all. Your customer is winning because you're guiding your customer rightly. You are winning because you are selling more products, innovating more products, creating more energy efficient kind of products. So this is the one side of the story. The second side of the story, again, as applicable for the banks, of late, any bank I discuss to, they want to say whether they are climate leaders, okay? Every bank wants to say, I'm a climate leader. Then there is the next category, which is aspiring climate leader. And then there is a third category which says, okay, I will follow these leaders. And there's a fourth category which says, I'll wait and watch. Let's see where this all goes to. Climate leadership title is a reputation tag for you. What it means that is the investors will come to you, the customers will come to you, the Zenex will come to you because they think this is a progressive bank. See, everything comes back to how your business model and operating model moves to adjust to this new reality. Is this a new reality? Yes, it is. And do we have to adjust to it? If we want to win, we do. And what does it mean to the rest of us here who are not? I mean, for me, it means a lot because I'm both a banker and a technologist, and climate tech, yes, is going all the way up. But for each of us as customers and as responsible global citizens, we would want to go to banks which are more, climate aligned, more ESG aligned, and that's what we all would want to do. What is in it for us as customers? Will the bank survive the long run is a question. Do I want to make a change is the next question. The third is, how is the reputation going and where am I contributing? So you see, at being a simple customer level, to being a bank, to being an investor, to being a regulator, the whole way of how banks do their operating model is changing, and these innovations delight me so much because it just needed common sense. It just needed some people sitting together and making a change. So on that note, back to you.
Thank you. I just want to wrap up. Thanks for listening for so long. Anna-Marie, we are seeing a range of approaches. We're seeing banks going through their loan portfolios, for example. What are you seeing as you help lenders specifically, and where do you think that banks might want to focus? Just to have some maybe takeaways from this panel and some actions that we can all think about and maybe take forward in our work.
Yeah, I think, look, there's a couple of really interesting things that are going on that banks can think about. One is, there is more and more information being put out by companies and clients through their transition plans, and I know that certain banks are already using that information in their assessments of their exposure to those clients. So I guess the first takeaway would be, you spend all of your time, trying to learn your client as much as humanly possible. I think the information that's being put out under sustainability reporting requirements is incredibly valuable information that you can start using in the way you look at your loan book, the way you run your processes, the way you think of developing new products. There is more and more information coming out of that that really can be a treasure trove for you. It's like asking all of your customers to go give you their forward-looking business plan. In some ways, this is going to be critical to understanding where these companies are and where you're going to put them on a risk profile and an opportunity profile. I think would be probably the first thing I would suggest. The second thing I think I would say, and this is just, you spend decades as a senior partner in a law firm, you kind of have to look about risks as well. The second thing is the wider stakeholder group is watching. So to the extent that you are out in front as a climate leader, as Saloni just mentioned, that attracts positive attention to you from a reputation perspective. There are a number of different rules coming into play in different parts of the world that require customers to look through and see who's in their supply chain, and banks are part of someone's supply chain if they're getting financing from it. So your loan book matters to the kind of 88% of the world's population that is committed to net zero targets. And so it's both kind of the carrot and the stick. There's great stuff that you can get from that and drive your own business, and then there's also a lot of upside from making sure that you're working to affect the transition and move into a resilient and sustainable future.
Thank you so much. And with that, I'm going to end the panel. Thank you so much for listening, and I think we can agree that this is going to be the issue that defines our times. So exciting times ahead in the banking sector, I think. Thank you so much for having us. Very much appreciate it.
Thank you, Tessa. And panelists. Fantastic. Great. Running nicely to time.
There's just one thing I'd like
Oh, gosh, no. Go ahead.
One word that I have learned since last afternoon is shukran.
Afwan. Right. Okay. Okay. Remember, I got an Arabic name. Yeah. Never forget. Okay. Thanks very much. That was fantastic. Really enjoyed that. Tessa, thanks for moderating. Maram, Saloni, and please forgive me, the lady on Anna Marie. Perfect. Yes, of course. Thank you so much. Right. So it's now lunch. Luncheon is served. May I ask that you make a point of coming back here on the dot at 1:15, which I've actually given you an extra 5 minutes. Look at that, see? If you could come back here 1:15 for our panel discussion on an equally important topic. They did away with LIBOR, that's a real pity, and now we've got all these kind of reference rates all over the world. You know, some of them are secured, some of them are unsecured, some of them are compounded, some of them have a term structure, but you can't use it unless you're not a bank, which you can use it. Great, makes a lot of sense to me. But what do I know? We've got a fantastic panel on benchmarks, developing benchmarks and derivatives for hedging. See, and we're all bankers, so these are the topics that really excite us. Okay, so I'll see you back here at 2:15 local time. Enjoy your lunch. See you soon. Take care.